Closed captioning of this program is brought to you in part by Interactive Brokers. Deep discount direct access. 90-plus markets worldwide.
Brian in Humboldt, Saskatchewan wants to know about Halliburton, HAL in New York. What's the view?
Right. So this is one of the granddaddies in the oil service group, and it certainly have been very strong executionally. Few issues here. First of all, technically, stock's held in better than the group, so I think that's a positive. I don't really like the oil service neighborhood right now. We have seen deteriorating breadth over the last 6 weeks as money's been rotating some of the larger cap yield-oriented companies. Issues you've got to deal with in Halliburton in the short run. We're about a year since the oil spill, and there's always potential litigation risk that could come up. They do have quite a lot of exposure in Saudi and North Africa. So you want to watch what's going on there politically. On the other hand, they've got lots of exposure to Brazil and all the billions of dollars that will be spent there. So if you're looking for an oil service company and you want to be in that sector now, we're not. This is a company I think you could own. I think it's very well run, very well capitalized, and the stock has held in better than the group through the course of this correction. Just be aware of those near-term potential catalysts.
We have Gino on the line from Toronto. Go ahead.
Good afternoon, gentlemen.
Afternoon.
With natural gas holding around the $4.20, and with the series of things we had in 2011, like we had a harsh winter, we had a harsh tornado season, we had a harsh flooding season. Chances are we're going to have a harsh hurricane season next month. Do you think it's a good time to get into Encana?
Encana.
Thank you.
So we have avoided, to this caller's point, gas as a whole. It has not been a fruitful place to be invested over the last number of years. The gas exposure that we have, we focused in the liquid-rich companies like Peyto, for instance, which I think looks quite good. There are people who would point to the fact that there have been record withdrawals from storage over the course of this winter as a potential positive. The problem is there continues to be this tsunami of new gas production coming on stream. And so I think that the pricing power is still suspect. Perhaps gas can get shaped up and look a little better going through the summer and into the fall. I just don't think this is the time of year to be chasing this group. I would prefer to have either very solid growth in production at very low costs or a significant yield and the liquids exposure, and that's really where we've tended to focus. So I think you could avoid the stock for now.
We have Gord on the line from Cochrane. Go ahead, Gord.
Yeah, I'm just calling about Hud Bay Minerals. I know David and Peter Brieger have picked it as a top pick in the past with $1 billion in cash. I bought it at $17.25, and it's been dropping ever since. So I'm not sure whether I should buy more. Is it cheap? Should I hang on to it, or should I dump it off, put my tail between my legs, and go lick my wounds? Thanks. I'll listen and hang up.
Thanks, Gord. So, look, I think the last 6 weeks have been a very tough time for a lot of Canadian investors because, Canadian market is 60% energy and basic materials, and this has not been the right place to be for the last 6 weeks. The metal stocks started to underperform first, probably because copper started to weaken before many of the other basic materials. So I think you have to remember, when you invest in resource-based companies, as Rick mentioned before I came on, you've got to pick your spots. And realistically, you've got to have a very disciplined selling strategy. And I think if you're going to enter these companies, you have to know where your exit is. And for us, we wound up getting stopped out of virtually all of our metal stocks through the month of March and into April. So we have very little exposure at all. Could Hud Bay get bought at some point? Sure. There are lots of very large companies hunting for assets right now. I think that the concern right now is that the measures taken in China to kind of try and take inflation off the boil are having some impact. I think that the real estate market is starting to show some signs of weakness, and I think that has washed through things like the Australian currency, the Australian market, the various commodity spaces, because they are the marginal buyer. And at this point, there's not enough that tells me that correction is done. I think it's a very hard thing for people to realign their thinking when markets go through changes. And this market, I think, has given us a very clear signal. Money is moving from highly economically sensitive companies to companies with more defensive characteristics. We're in the third year of an advance. Earnings estimate increases are slowing down. And so I think you don't want to be focused on the high octane necessarily. I think you want to be focused on yield and more predictable earnings. And, Hudbay just isn't there.
We have Michael on the line from Woodbridge, Ontario. Go ahead, Michael.
I'd just like to get the guest's opinion on Telefonica. I know they have a high yield, but their European business sort of worries me a little bit. If I can get his thoughts on that.
Sure. Telefonica, lots of business in Latin America and in Europe. We would tend more, and it's unpopular, to focus on the domestic telecom companies like Bell and Telus. And then, frankly, we also own AT&T and Verizon. And I choke when I say that because I've disliked the group for so long. But these companies have gone through pretty good restructurings. Their costs have come down. Wireless seems to be stabilizing. And I would focus in North America as opposed to focusing overseas for these companies right now.
Coming up, we're going to get to David Burrows' top picks, and is he ever defensive? You don't want to miss this. Coming up.
Base metals,